All right, I think we're ready. Welcome back, ladies and gentlemen. My name is Larry James. My company is Speak with Larry, no spaces. And what I'm going to be talking about today are index funds, IRAs, and a host of other things that I'm sure you'll find very interesting in reference to the stock market. Now, remember, I'm doing two things at once simultaneously as I'm sharing information and teaching you about the stock market. I'm also teaching you about the process that my company does to help people set up the foundation of an online business. And one of the things that we do is we help you become more comfortable speaking about your particular area of expertise that you're going to be embarking on, right? Because that's necessary once you are able to set your system up, that you're able to talk about it. You're able to guide people along the path that you took or a similar path that will help them in their on their journey, right? Because it's all like, it's not like, you want to gather all that information and share you want to share it. You don't want to just hold it in. You want to let the world know you possess that information and can help them. And then, they will reward you by paying for your products or services that you have to offer. Now, initially, you may not have any products or services. That's fine. There are several ways you can actually generate an income without having specific products or services that you create, but there are, different margins there. You can be aware of that. When you create, like, I'm a published author, right, of several books. If you market one of my books, I'm probably going to give you a percentage. But if you write the book, you get the whole, the whole 100%, right? That's the beautiful part about being able to market your products as you create them. You can start small, then you can move up. But before that, if you don't have any products, you can become an affiliate for certain companies like Amazon, eBay, different platforms that allow you to generate income while you're doing your work, while you're building your process. And, before long with my system, you'll already have your products, right? You'll create a product one per month in the form of an online course that you're going to be allowing people to purchase and learn from what you put together, right? You're going to create a curriculum that's very simple, and you're going to be the orchestrator of all that. So that's going to be repeatable, if you will. Once you do one, you're going to do another. You're going to do another. You're going to do three simultaneous, not at the same time, back to back to back, right? You're going to create, like me, I'm creating one course for March of 2021, one for April and one for May. That's three different courses that I'll have available at three different price points. And then I'll bundle them together and sell that for another. That means there'll be four products I have that I can always market, no matter where I go, what I do, what's going on, or whatever. I don't do the marketing. I pay someone to market it, right? Hire someone to market the service or products that I create. And then, I just continue creating content. That's one of the things you want to be able to outsource, because there are people who, are good at marketing, and that's what they do. And that's what, you want to pay them a fee. You can write that off as a portion of that off as, expense for growing your business, and, just keep that moving like that. All right. So listen, I really appreciate you guys, following me here on this journey, because I like to create goals. I'm a goal setter. So once I create these three online courses or four online courses, then I'll move to something else, right? Now I've got those working for me already, right? Actually, this I've already created three courses prior to this one, so that'll be seven courses that I have available that are being marketed online at all times, 24 hours a day, right? Different price points, because people can get in on different levels, right? And that's what you want to make things available for people that are, beginners, intermediate, and advanced. That way you cover the whole bases, right? Okay, well, I'm not going to take too long on this one. I think this is a pretty short, but it's kind of intense. with the IRAs. A lot of people are not really familiar with IRAs, and I'm going to cover those fairly thoroughly today. So we're going to begin. The first definition is index funds. What are index funds? An index fund is a type of mutual fund or exchange traded funds, ETF, with a portfolio constructed to match or track the components of a financial market index, such as the Standard and Poor's 500 index or S&P 500. An index mutual fund is said to provide broad market exposure, low operating expenses, and low portfolio turnover. Now, these funds allow their benchmark index regardless of the state of markets. And index funds are generally considered ideal core portfolio holdings for retirement accounts, such as individual retirement accounts, IRA, or 401k accounts. Now, legendary investor Warren Buffett has recommended index fund as a haven for savings for the later years in life. And rather than picking out individual stocks for investment, he has said it makes more sense for the average investor to buy all the S&P 500 companies at the low cost an index funds offers, which makes sense, right? Because you're older, your risk tolerance is low. You don't really want to be losing bundles of money, right? Like when you're like 20, 25, 30, you can lose, 50, 60,000, 100,000 sometimes. But you have a longer window to recover or recoup that, right? When you're 60, 70 years old, that window is very, very small, right? Okay, next, what is an individual retirement fund or individual retirement account, IRA? I'm sure you've heard of those, or you probably have one. If you don't, I'm going to be happy to explain to you what that does. Now, an individual retirement account is a tax advantage account that individuals use to save and invest for retirement. The Internal Revenue Service also uses the term individual retirement arrangements to broadly refer to individual retirement accounts, individual retirement annuities, and other trusts and custodial accounts that act as a personal savings plan with tax advantages for setting aside money for retirement. And there are several types of IRAs. There's a traditional IRA, there's a Roth IRA, there's a SEP IRA, and a simple IRA. And each has different rules regarding eligibility, taxations, and withdrawals. And I'm going to go over each one of those temporarily, just a little bit of information on each one so that you can kind of wrap your mind around what an IRA actually is and how you want, or which one would work better for you in your situation, right? Now, what is a traditional IRA? A traditional individual retirement account allows individuals to direct pre-taxed income toward investments that can grow tax deferred. The IRS assesses no capital gains or dividend income taxes until the beneficiary makes a withdrawal. And individual taxpayers can contribute 100% of any earned compensation up to a specified maximum dollar amount. Income thresholds may also apply, though, and contributions to a traditional IRA may be tax deductible depending on the taxpayer's income, tax filing status, and other factors. Now, retirement savers may open a traditional IRA through their broker, including online brokers or robo advisors or financial advisors. Now that's traditional IRA. Now, next is Roth IRA. What is a Roth IRA? I'm sure you've heard of that, right? Well, a Roth IRA is an individual retirement account that allows qualified withdrawals on a tax-free basis provided certain conditions are satisfied. Now, established in 1997, it was named after William Roth, a former Delaware senator. And Roth IRAs are similar to traditional IRAs, with the biggest distinction between the two being how they are taxed. Roth IRAs are funded with after-tax dollars. The contributions are not tax deductible, but once you start withdrawing funds, the money is tax-free. Conversely, traditional IRA deposits are generally made with what's called pre-tax dollars. You usually get a tax deduction on your contribution and pay income tax when you withdraw the money from the account during retirement. And this and other key differences make Roth IRA a better choice than traditional IRAs for some retirement savers. So that's two IRAs that I've covered there. Now, when you're doing this, a lot of times you're going to run across things that kind of confuse you at that point because you're not really familiar with the terms or the technology. But don't let that deter you. Just keep going, and you'll find yourself being around people who will help you to understand it better. Or watch videos, and things will begin to click in your mind so that it keeps you balanced, right? Because you don't want to be always learning, always learning. You have to be creating too in this industry. You're going to create. So initially, you're going to be probably learning 90%, creating 10%, learning 80%, creating 20%. You actually want that to flip, where you're actually creating 90%, learning 10, creating 80%, learning 20. You see how that works? Now, the next is what's called a SEP IRA, Simplified Employee Pension is what SEP stands for. And a simplified employee pension is an individual retirement account, IRA, that an employer or self-employed person can establish. The employer is allowed to a tax deduction for contributions made to a SEP IRA and makes contributions to each eligible employee's plan on a discretionary basis. Additionally, under the Setting Every Community Up for Retirement Enhancement or SECURE Act, which was enacted on December 20th, 2019, small employers get a tax credit to offset the cost of starting a 401k plan or simple IRA with auto enrollment. That's on top of the startup credit they already received. And SEP IRAs often have higher annual contribution limits than standard IRAs. Fundamentally, a SEP IRA can be considered a traditional IRA with the ability to receive employee contributions. And one major benefit that it offers is that it offers employees that employer contributions be vested immediately. Okay, and finally, we have the simple IRA. A simple IRA is a retirement saving plan that most small businesses with 100 or fewer employees can use. Simple stands for Savings Incentive Match Plan for Employees, and IRA stands for Individual Retirement Account. Now, employees can choose to make a non-elective contribution of 2% of the employee's salary or a dollar for dollar matching contribution of the employee's contribution to the plan up to 3% of their salary. And employees can contribute a maximum of $13,500 annually in 2021. The maximum is increased periodically to account for inflation. And retirement savers ages 50 and older may make an additional catch-up contribution of $3,000, bringing their annual maximum to $16,500. Interesting, right? So those are things that you want to consider when you're getting closer to retirement, or if you're, you may be at that retirement point already. Either way, you want to be flexible and you want to be uh, proactive, right? You want to do things consciously, on purpose, in advance, right? Like what you're doing. That's how you want to set your system up. That way, as you actual actually start to generate or deposit more money, you start to generate money on that compound interest point of time, part of town. And that's the beautiful side of the world. That's where you pay interest on interest. And that's a fantastic once you get to that point. Now, next, we're going to talk about a little trading. You've heard of the term insider trading. If I ask you what does insider trading mean, would you know what that means? Insider trading. You've heard it, right? So what exactly does the term insider trading mean? Glad you asked. Insider trading involves trading in a public company's stock by someone who has a non-public material information about that stock for any reason. Let me repeat that. Insider trading involves trading in a public company's stock by someone who has non-public material information that's about that stock for any reason. Non-public, which means everyone is not privy to that. Now, insider trading can be either legal or illegal, depending on when the insider makes the trade. It is illegal when the material information is still non-public, and this sort of insider trading comes with harsh consequences. Harsh consequences. In other words, stay away from that, right? So what's an insider? If that's insider trading, what's an insider? An insider is a term describing a director or senior officer of a publicly traded company, as well as any person or entity that beneficially owns more than 10% of a company's voting shares. For purposes of insider trading, the definition is expanded to include anyone who trades a company's shares based on material non-public knowledge. And insiders have to comply with strict disclosure requirements with regard to the sale or purchase of the shares of their company. Got it? So this isn't that difficult, right? Insider trading is something that you should know by now that I just went over that. Next, we're going to talk about high yield bonds. High yield bonds, also called junk bonds, are bonds that pay higher interest rates because they have lower credit ratings than investment grade bonds. Now, I want you to pay attention to this high yield bonds, right? It's kind of like having good credit versus bad credit, right? When you have bad credit, you pay more for what you get because of your credit score. When you have good credit, you get benefits for having good credit. Now, high yield bonds are more likely to default, so they must pay a higher yield than investment grade bonds to compensate investors. So when a bank gonna loan you money, if you've defaulted on other loans or you have a low credit score, they're gonna charge you more for that money, right? Now, insurers of high yield debt tend to be startup companies or capital incentive firms with high debt ratio. However, some high yield bonds are fallen angels that lost their good credit rating. As I just said, when you got good credit, you can get benefits. When you don't have such good credit, it's going to cost you a little bit more. You're going to have to be more strategic, right? And, that's one of the benefits of working hard and maintaining your credit. Now, what exactly is a junk bond? A junk bond are bonds that carry a higher risk of default than most bonds issued by corporations and governments, which means you can buy them, but the risk is higher. A bond is a debt or promise to pay investors interest payments along with the return of invested principal in exchange for buying the bond. Now, junk bonds represent bonds issued by companies that are financially struggling and have a high risk of defaulting or not paying their interest payments or repaying the principal to the investor. And junk bonds are also called high yield bonds, which is what I just went over, since the higher yield is needed to help offset any risk of default. Now, you've probably heard the term supply and demand, right? Do you know what supply and demand actually means? Supply and demand. Those are business terms. The law of supply and demand is a theory that explains the interaction between the sellers of a resource and the buyers of a resource. The theory defines the relationship between the price of a given good or product and the willingness of people to either buy or sell it. Generally, as price increases, people are willing to supply more and demand less, and vice versa when the price falls. Let me read that part so you didn't get that misunderstood. Generally, as the price increases, people are willing to supply more and demand less, and vice versa when the prices fall. Now, the law of supply, what is that? The law of supply is the microeconomic law that states that all other factors being equal, as the price of a good or service increase, the quantity of goods or service that suppliers offer will increase, and vice versa. The law of supply says that as the price of any item goes up, suppliers will attempt to maximize their profits by increasing the quantity offered for sale. Now, what is the law of demand? I just read you what's the law of supply. What is the law of demand? The law of demand is one of the most fundamental concepts of economics. It works with the law of supply to explain how market economies allocate resources and determine the price of goods and services that we observe in everyday transactions. The law of demand states that quantity purchased varies inversely with price. Quantity purchased varies inversely with price. In other words, the higher the price, the lower the quantity demand. In other words, if you have five $1,500 phones and $10,000 phones, people are going to 9 times out of 10 want the lower price first, right? This occurs because the diminishing marginal utility. This is consumers use the first units of an economic good they purchase to serve their most urgent needs first, and use each additional unit of the goods of service successively lower valued ends, right? That's pretty simple to understand, right? That was kind of cut and dry, but I like to share things like that because a lot of times people hear these terms, but they don't really know what they mean, or they can't really equate it to something, or they do know what it means, and what they're hearing is just repetitive, just reinforcing what they already know to be a certain thing, right, or a certain way. So with that, that's going to end this episode's version of Speak with Larry's Understanding the Stock Market. And one of the nuggets I want to share with you today is that once you begin this process, never, ever stop it until you complete it. When you set a goal, don't change the goal, change the direction you may have to go to get to that goal. Don't change the goal, change the time it may take you to get to that goal, but keep focused on that goal, because if it means something to you and you put in the work and the effort, the universe will help you acquire that. It will move itself around. It'll move people around. It'll move situations to where you can benefit, opposed to struggle and be misinformed about what needs to be done to get that accomplished. That's how it works. You have to be committed to it, because if everybody wanted it, or if everybody just wanted it because they wanted it, like poof, it's not going to happen like that, because you have to put in work. You have to show yourself worthy, that you deserve what it is that you want. Because think about lottery winners. When they win all that money, within the next 2 or 3 years, they're probably broke, or right at broke, or back to where they were. How do you win $10 million, $30 million, $100 million that you never had, and then you're broke in 3 years? You don't know money. You don't understand money. You don't spend time learning money. You spend time spending money. You become a bigger consumer. See, what money is a seed designed to be planted in, metaphorically, and grow. You have your dollars working for you, opposed to you working for your dollars. And once you're able to understand that concept and set systems up so that your money actually works for you, your life is never going to be the same. You never have to worry about money. You have to concern yourself with still like your health and your sanity, and your relationships and stuff like that. But money's not going to be the issue anymore. And the sooner you learn that, the easier it works out for you. Which is why people like myself and others, we do our part to create content that you can process and digest, and that can move you, to the next stage or the next level, because it's about that, and at the end of the day, you do want to be growing, right? I figured you did. All right, again, I appreciate you stopping by or purchasing this product. Hopefully you got a lot of information out of that. I thoroughly enjoyed sharing it with you. And as I always like to end on each episode or each class that I create, my name is Larry James. My company is Speak with Larry. And as always, share with someone else what I've shared with you.